Fundsindia's Market Lounge Reloaded. I'm Sharon and I'll be moderating the session. Today we shall discuss markets at all-time high, how to invest. Mr. Arun Kumar, our research head, will start the session.
Yeah, thanks a lot, Sharon, and thank you everyone for joining for this session. See, broadly, I think the biggest question in most of our clients' mind would be that, obviously, at 60,000 to 62,000 Sensex levels, the markets were kind of stuck for almost 1.5 years. And every time it used to come close to that 62,000 levels, then we generally saw it again correcting by 10-15%. So most of them were expecting that the pattern would again repeat. But as all of us know, it's kind of gone up after that. It's almost close to 67,000 levels. So the broad question now is that what should we think about it, in the sense like, will it again continue to fall or will it again continue to go up? What is happening? And is this like a rally purely driven by FII flows, or are there some fundamental drivers behind it? So that's the intent. It's a very simple presentation. I just have 3 slides, but I think the most important slide is the next slide. See, at the heart of it, while all-time highs and all that are unnecessary distractions, the broad idea is that over long periods of time, markets kind of reflect the underlying earnings. The other parameter is your valuations. But again, valuations, while they go up and down in the short run, over long run, they kind of mean revert, right? So even if you start at some of the extremes, either you buy it extremely cheap or buy it extremely low, over long periods of time, the impact kind of evens out. So which means that if you buy at extremely low valuations, you might get returns which are slightly over and above your earnings growth. The shorter run, this will be a lot higher, but over long periods of time, it will be earnings growth plus whatever 1-3% extra returns due to the valuations going up. And then similarly, it will be vice versa, depending on where the valuation cycle you're entering. So broadly, the simple takeaway for all of us is that over long periods of time, fundamentally, the markets will go up as long as earnings is growing. The moment earnings is not growing, then the markets will then it is no more supported by fundamentals. So whenever there is a confusion, it is always better to go back to the basics and ask, saying, what is happening under the hood, which is under the bonnet, what is happening to the earnings. Now let's start from Jan 20, where the Sensex was at its previous peak. So Sensex was getting stuck at 41,000 levels almost from 2018, right? And again, after this, it fell. But broadly, at that point in time, the price to earnings multiple was slightly higher, almost close to 28 times. The reason was also because the earnings growth was expected to come back almost from 2017. A lot of us were expecting the earnings growth to come back. See, broadly, the earnings growth also goes through cycles. So we had a very long cycle starting from 2010 almost till 2020. The earnings growth was sub 5% for either the Nifty or Sensex or Nifty 100, BSE, whichever cuts and slice you do, roughly around that 5% band was the earnings growth, which is extremely low. So broadly, while overall, if you look at historical long-term averages, is somewhere close to the 12, 13, 14% range. So the broad expectation was that whenever earnings growth start to come back, the early phase of recovery will be extremely strong. And that's precisely what happened. While nobody was exactly sure on when the turning point was, most of them were expecting it to happen in 17. But then Demon happened. Then again, GST happened. And then again, there was an NBFC crisis. And then again, COVID, there was an auto slowdown. So something or the other always kept happening. And that is why the earnings growth were getting delayed. But again, the more and more it get delayed, it just means that whenever it turns, it'll be extremely sharp. And that's exactly what happened. If you look at the earnings growth, it was close to 30% between Jan 20 and the middle of, say, around December 21. Now, these 2 years, all of us know that were marked by COVID. There were a lot of lockdowns and all that. But despite that, the earnings have been really strong at close to 30%. But again, look at the markets went ahead of the earnings. So market returns were 50%, while earnings was only 30%, because the markets kind of recognized that the earnings growth is coming And despite all the underlying COVID and all problems, despite that, the earnings growth was coming, and hence the market preempted a lot of the returns, right? And then what happened post that was that the return stagnated. So you can see the second half, that is probably from the October, November to 21 till that 65,000 levels, it is the returns have been close to 5%, right? Whereas if you look at the underlying earnings growth, it was almost close to 44%. So technically, what has happened is that over the entire stretch, the earnings growth is almost close to 88%. So which means the earnings have grown at 20% CAGR vis-a-vis sub 5% for the previous 10 years. And this is exactly what happened when our earnings growth kind of turned back. Right? Now, obviously, markets were preempting a lot of it, which is why the valuations were very high at 28 times. But now the valuations have kind of corrected. So why are we not getting 88% and only 57? The remaining was already factored into the valuation. So you always have to remember that for long periods of time, while the returns will almost come close to EPS growth at say 15-year periods or 10-year periods, in the short run, there will always be lead and lag. So sometimes markets will run up ahead of earnings, and again they will stagnate. The markets will stagnate while the earnings growth will do the catch up, and that's exactly what has happened. So overall, the key underlying thesis is that broadly, whatever returns that we are seeing till today is predominantly, or in fact, is more than compensated by the earnings growth. So, in fact, the returns have lagged the earnings growth because the valuations have started to come down. So, this is the starting point, that while valuations are still not extremely cheap, but the key point is that the earnings growth cycle has started. And as long as this earnings engine is strong, your markets will continue to go up, mirroring the earnings growth. So this is a very, very important slide. So anybody who is thinking that the last 60% returns that we got from 40,000 till here was just driven by whatever technical factors or some momentum, sentiment, and all that, it is actually driven by far more by fundamentals. In fact, because the expectations were built earlier in terms of valuations going up, because everybody was expecting this, some part of the earnings growth has not reflected in the returns. So overall, the broad sense for us is that earnings growth cycle generally goes for 5 to 7 years. And from the evidence that we have seen, we are seeing corporate capex is still not started, but there are a lot of signs of corporate capex almost about to get started. So which means that the first leg where you got 20% earnings is coming from a low base, but the next 2 to 3 years will predominantly be driven by corporate capex. And again, it won't be as high as 20%, but it's a good, the consensus is somewhere close to 15%. And I think our expectation is also that we hit a number close to that. And good fund managers may be able to pick funds or stocks which are able to deliver a better earnings. But broadly, the theme is that we are in a very strong earnings growth environment for the next 3 to 5 years. And then eventually we'll come to a stage where earnings growth is extremely high for 6, 7 years, and corporates and everywhere there is leverage, there is excess capacity addition and all that. But that is, my sense is that it's still a long time away. Right now, the corporate capex is just about starting, and it's not even like, it's just like very nascent state. So that will again drive the earnings growth for the next 2, 3 years. Banks are at a super sweet spot. Your consumption cycle, or at least on the top end of the curve, that is the rich is getting more richer, and the consumption is being very strong. And whenever historically countries, when they cross that $2,000 per capita income, the consumption mix also kind of changes more towards premium category. So a lot of stuff is happening, and manufacturing, again, there's a lot of traction on the manufacturing side. So broadly, our sense is that till now returns are driven by earnings growth. And again, earnings growth is expected to be strong over the next 2, 3 years. So which means the returns will continue to track the earnings growth. Now, overall, the general framework that we use for all-time highs is a very simple thing, that all-time highs does not mean a market crash. Generally, what happens is that mathematically, if you look at it, any asset that has to grow will have to continue to hit several all-time highs. Now, if all of us say we are expecting 12% returns from equities, then it means it has to double in 6 years and go 4x in 12 years. So which means that from 60,000 levels where we started, if it has to double in 6 years, it has to go to 1,20,000. Then again, in the next 6 years, it has to go to 2,40,000. So for an asset class where you are expecting 12% returns, in other words, you are saying in the next 12 years, it will be somewhere close to 2,40,000. So for the markets to go to 2,40,000. It's no way it can go there without hitting all-time high. So just like how Sensex from 100 has hit 65, 66,000 today, crossing all the all-time highs, it's a very natural part. So every time we get scared out of all-time highs, it means that basically we can't participate in this asset class. The second most important thing that we had iterated the previous time we met and also in our blogs is that while markets will stagnate at certain all-time high levels for some time, the breakouts happen usually after probably 1-2 years. Now, this time also, we think most likely this might be a breakout because if you historically look at it, first Sensex was stuck at 20,000 levels from probably 2007 it hit, and then almost till 2013 for 5 long years it was stuck. But again, it was at a bubble valuation and hence it got stuck there for a long time. But then after that, it went on to the next level from 20,000. After 2013, it directly jumped to 40,000. And then from 40,000, it again got stuck for from 18, 19, 20. So again, 2 years. Then after that, it again went to 60. Then again, now it's got stuck there. So most likely, if it is a similar pattern repeating, it's very unlikely that the move kind of stops now. So my sense is it might go even higher from here, given the fact that the FIA flow is also very strong. So key driver in the near term is FIA flows. But again, historically, the pattern is that when breakouts happen after these kind of consolidation, the levels are far, far higher compared to, and it's not like a very small move. It's usually a 50% to 100% kind of a move because first time it was 20,000 to 40,000. Second time it was 40,000 to 60,000. It's almost like a 50% move. So I think the moves are usually very, very large. And we have also tested a simple thing that from last 23 years, from the time when we have Nifty 50 TRA data, when we check what was the returns that you normally got when you invested only in all-time highs, the 1 year average was almost 14%. And in fact, like 50% of the times you made more than 15% returns. So, and almost 6 out of 10 times you made a return of more than 12%. So there's nothing to say that because you invest in an all-time high, the markets will fall. But it's natural to psychologically get a little scared, but there is hardly anything to worry about an all-time high in isolation. So the key question is, when should you worry? For us, it's very simple. All-time has nothing to do with how we decide when to go underweight. We will go underweight or we will worry only when three conditions come together. One, the valuations become very expensive. Two, we go to the last stage of earnings cycle. And three, the sentiments are extremely euphoric. So right now, out of the three signals, when markets hit 60,000, we were still at expensive valuations. While now we have crossed to the very expensive valuation. Now this we do it based on something called the FI value meter, where we check four valuation parameters: price to earnings, price to book, market cap to GDP, and we compare earnings yield to bond yields. Now we put all these together, put it from 0 to 100, 100 being very expensive, 0 being very cheap. Right now we are somewhere close to 80 plus. 85 is the current precise number. So it has crossed 8. So 80 plus is a red signal for us. But let's say maybe if I had to do it 10 years back, I would have been naive and then I would have just gone only with the valuation. But after experience, I've also realized that both globally and in India, only going by valuations is not a great way to play the next 5 years, because valuation signals are sometimes very, very back-ended. And for all that, markets will continue to go up another 50, 60% and then probably fall from there. So valuations are not a great timing indicator. So what we did was to improve the efficacy, we combined that with the sentiments and the earnings growth indicator. Earnings growth, we think we are still in the early stage. Unless and until corporate capex starts, we won't move to the middle stage. And then after that, if that continues for another 3, 4, 5 years, the capacity utilization becomes very high. Companies start to borrow like crazy. Companies are putting plants left, right, center. So you will find a lot of positive news flow and all that. But that, my sense is, it's still 2-3 years away. So we are still in the early stage. So which is like a super green signal. And sentiments also, usually what will happen, FIA DIs will be extremely positive. My sense is FIA flows have just about started to come. They took out 2,70,000 crores, but they have only brought back in 1,60,000 crores. So they have not incrementally added, and whatever money they have taken out also, they have not been able to deploy it back entirely. So FIA flows on that level is still net negative. DIA flows have continued to be positive. IPO sentiments are just about picking up. They went through a long lull, so nothing great there. Again, new investor addition has also slowed down, and market was also almost flat for close to 1.5 years. So right now we are seeing it picking up after almost like a 1.5 year consolidation. So overall, we are not seeing any all three signals that are required for us to be worried about a bubble. Only one signal is there, the other two are not there. So right now we are not worried about a market bubble. So essentially, what should you do? I think the logic is very simple. Continue with the original split between equity and debt. So if somebody is your client is at 70% equity, don't make it 80, don't make it 60. Continue with 70. Most likely because of markets going up, maybe that 70 might have crossed say 75 or 76. So if the allocation is moved up beyond 5%, and then you can rebalance it back to 70%. Otherwise, you can maintain it. If let's say it's only at 73 or 74, you can continue with it. The key challenge would be on how to invest the new money. For new money, our model is based on the value meter. So right now it's at 85. So which means 80% of the money, new money, let's say I'm getting 100 rupees to be invested in equity, 80 rupees, I will split it for the next 6 months weekly STP, and the remaining 20 I will invest it immediately. So this is how we are broadly investing both existing money. We are just maintaining the asset allocation. For newer money, we are going a little slow and staggering it over 6 months, primarily because of the fact that valuations are on the higher side. So there are 3.5 behavioral mistakes that normally happen during a bull market, and these are the 3.5 mistakes that we'll have to avoid. The first mistake is simple, that every time the market hits all-time high, people take out the money in the name of profit booking or going underweight. The biggest difficulty is it'll be very difficult to enter back, because what happens is the markets don't go up slowly. What usually happens during a bull market is that, especially when everybody knows that earnings growth is coming, sometimes returns get front-ended, like what you saw earlier. So the next 3-year returns, for all that you know, might sometimes get fronted in the next 6 months to 1 year. Then again, you will go through a 2-year period of consolidation. So which means that if somebody tries to time out, then for most often than not, you might not get the previous levels at all, because like the markets will go up and probably consolidate over there. So which means that you will also get frustrated and you will never get the levels back. And it's very, very difficult. Even if you get the levels back, it'll always feel like it will probably go down further. So let's say you took the money out at 60, now it is at 67, and again it goes to say 75,000. From there, even if it falls 20%, you are still back to 60,000. But the point is, let's say if it falls 15%, now will you enter or will you not enter? Because now you're waiting saying, I took out my money at 60, but should I again enter back at whatever, 64,000 or 65,000, right? So it becomes very, very difficult psychologically to, and then the mind games it starts to play makes any investor very, very anxious. So in our experience, we have seen that once you take the money or you take the money out, becomes very, very difficult to deploy, because you're always second guessing, saying, will it go down further or will it go up further? So the key mistake to avoid is do not try to go underweight in a bull market, trying to say I will try to avoid the next 10 to 20% fall and then again get back in after 10-15% fall. It might end up really, really messing up your portfolio. The second mistake is when it comes to new money. Usually people will procrastinate, saying that markets have already run up a lot, let me wait. But for all that we know, it might end up at 70,000 or 75,000 level. Then it becomes even more difficult to deploy. Just think about somebody who probably procrastinated the last 1.5 months, right? It was at 60,000, now it's probably at 66, 67. So it's already up 10%. So if you had a 1 crore portfolio, you have already missed 10 lakhs. Now the point is, it's not about the 10 lakhs that really matters, but over a 12-year or over a 20-year period at 12% returns, you roughly make 10x. So which means the cost of that 1 month delay is almost 10 times on a 20-year period. So that extra 10 lakhs that you could have got is almost equivalent to hit of 1 crore on a 20-year basis. So imagine every time there is a bull market, you kind of keep making these small mistakes. Let's say in a 20-year journey, you make 10 or 20 mistakes like this, where you kind of miss only 5-10%, but all these will compound over the long period of time. So that's how over long periods of time, you end up losing a very, very large amount. So this is the second mistake that most clients will make. that the incremental money that comes, they will keep waiting, and a lot of money will get stuck in debt, and they will keep waiting and playing the waiting game, and before they realize, the market would have gone up sharply, and probably they'll never get the original levels back, but probably it'll get consolidated at those levels. So while over a 3-year period, it will look like markets have gone nowhere after hitting the all-time high. But the point is, it might not come back like what you saw last time. Last time, it never crossed the 50K. It was coming to 52, 53,000 levels. Then again, it went back to 60,000 levels. So now it looks like for somebody waiting at 50,000 levels, it becomes even more difficult because you need a larger and larger fall as the market moves up. The third mistake is performance chasing, because once the bull market happens, inevitably there'll be certain sectors which do well. Right now, small caps are doing insanely well. So people might want to go overboard on all this, primarily looking at the past performance. And usually there'll be one or two mutual funds doing a particular style which do extremely well. So there will be a temptation to go overboard on all these. So it is very critical that you maintain the original split with different investment styles. And there will be styles which are not performing, but you have to also ensure that you have styles which are not performing, because otherwise, whenever the environment changes, you will be caught with one single style, and the downside that you will face will be on the entire portfolio. The last mistake is not a bull market mistake. It's probably a bubble market mistake. So at this level, I would still say this is probably a half a point mistake, because we are still some time away. This is probably what will happen when clients miss out on the rally, and then say at far higher levels, they get frustrated that they've been waiting for 1-2 years. They have not got the levels back while the markets have gone insanely high. A lot of their friends are making money. And then to overcompensate, instead of 70% equity, they'll go 90%. They'll add incremental money at those higher levels. And they will do aggressive sectors like, say, small cap funds, or they'll take sectoral bets to compensate for what they missed out because of sitting out of the rally. And this usually ends up really badly. So this is not a big problem right now, but my sense is at some point in time in the future, maybe 1 year, 2 year, 3 year out, we might get into this. So which is why I've given a half a point instead of making it 4. Right now, we don't need to be worried too much on it, but this is a mistake that you will definitely have to address at some point in time in the future. So overall, these are the 3.5 behavioral mistakes to avoid in a bull market. So overall, our view is very simple, that we are continuing to write this, which was our original view as well. We think the earnings growth, which is the fundamental driver, is going to be positive over the next 3 to 5 years. Around that 15% is where the consensus is. And we are also more or less on the same camp. So which means that, and again, the markets usually will start preempting all this and front loading it, given the fact that FIAs are still underinvested, and there's a lot, FIAs can really surprise us on the upside. That will be the biggest upside risk. If FIA flows continue the same pace, or like they panic and then they come all in into India, what should happen? Probably 2 year, 3 year returns might get front ended in 6 months to 1 year. So the biggest risk personally for me is on the upside. The normal risk of a 10-15% fall is always there. So that we are really not bothered. But I think the key risk is on the upside and not on the downside, and it is supported by earnings growth. So for current existing portfolios, we continue with their original equity allocation, and we are riding the rally up. And for newer money, we are going a little slow in terms of deployment, primarily because of concerns of valuation. So that's the simple strategy that for following. Newer existing money, we are continuing to play. Newer money, we are going slow in deployment, but we will definitely deploy it in 6 months. So that's the broad thing that I wanted to share for today.
Thank you, Arun, for the very informative session.
Thank you so much, everyone.
Thank you all for your valuable time. We're eager to hear your views on this session. So we'll be sharing a link in the chat box. Kindly respond to it. And until next time, this is Sharon signing off. Have a good day.